It was a trap. Silver jumps, 335, 5%. The fake crash revealed it was a trap. Silver just surged 335 in a single session. A 5% jump that defied every analyst prediction. But here's what they're not telling you. 3 weeks ago, silver crashed. Institutional money vanished overnight. Retail investors panicked. The headlines screamed collapse. Yet during that exact window, someone was accumulating quietly, methodically, while everyone else was selling in fear, and now the truth is surfacing. This wasn't a crash at all. It was engineered extraction, a wealth transfer disguised as market chaos. The fake crash has been revealed, and what comes next will catch most investors completely unprepared. Welcome to Financial Inspection, the channel where we examine what the mainstream financial press conveniently overlooks. Now, if you've reached a point in life where you value your time, where you've learned that real wisdom doesn't come from headlines but from careful analysis, then perhaps you'll find value in subscribing to this channel. We're not here to entertain. We're here to inform those who take their financial decisions seriously. And before we proceed, we're curious. From which corner of the world are you watching this analysis? Drop your location in the comments. Let's see how global this audience truly is. On a quiet Tuesday morning in late December 2025, something unusual happened in the silver markets. The price jumped 335 per ounce, a 5% surge that sent shockwaves through trading floors from New York to Singapore. But this wasn't just another commodity rally. This was the moment the mask slipped, and sophisticated investors realized they had been watching a carefully orchestrated deception unfold right before their eyes. For 3 weeks prior, silver had been falling, not gradually, but in sharp, violent drops that triggered panic across retail investment platforms. The headlines were everywhere. Silver crashes, as investors flee precious metals, end of the commodity supercycle. Why smart money is abandoning silver. Thousands of small investors watched their positions hemorrhage value. They sold, some at a loss, others in pure fear that worse was coming. The market narrative was clear and unanimous. Silver was finished, but a handful of analysts were watching something different. They weren't looking at the price, they were looking at the volume. And what they saw didn't match the story being told. During the steepest drops, massive buy orders were being executed, not by retail investors, not by small traders, but by institutional accounts, the kind of accounts that move markets, the kind of accounts that have access to information others don't. One London-based precious metals analyst spent late nights examining the data. He pulled trading records from multiple exchanges, cross-referenced them with physical delivery requests, and discovered something startling. While paper silver prices were collapsing on futures exchanges, physical silver was becoming harder to acquire. Dealers reported delays. Premiums on physical coins and bars were rising, not falling. Rising. The disconnect was glaring. If silver was truly collapsing in value, why were people paying more to own the actual metal? The analyst shared his findings with a small circle of institutional clients. Their response was immediate. They began accumulating positions. Quietly, without fanfare, without press releases, they understood what was happening. This wasn't a crash. It was a shakeout, a deliberate mechanism designed to extract silver from weak hands and transfer it to strong ones. The pattern wasn't new. History showed similar episodes in 1980, again in 2011, and once more in 2020. Each time, the same structure appeared. A sharp, fear-inducing decline, followed by a recovery that caught most investors off guard. And each time, wealth transferred from those who panicked to those who understood the game. But this time, something was different. The macroeconomic backdrop had shifted. Central banks worldwide were dealing with persistent inflation. Government debt levels had reached unprecedented heights. Currency debasement was no longer theory. It was policy. And silver, often overlooked in favor of its more prestigious cousin gold, was quietly positioning itself as a critical asset in the emerging economic landscape. The industrial demand remained robust. Solar panel manufacturing required silver. Electric vehicle production required silver. 5G infrastructure required silver. Yet the price had been suppressed through paper market mechanisms, futures contracts that represented far more silver than actually existed in deliverable form. A leverage ratio that would terrify anyone who understood its implications. When the 3.35 jump happened, it wasn't random. It was the inevitable result of unsustainable market structure meeting reality. Too many paper claims, not enough physical metal, and institutional players who had positioned themselves perfectly for this exact moment. The retail investors who sold 3 weeks earlier watched in disbelief. They had been trained to follow the narrative, to trust the headlines, to believe that price action always reflects fundamental reality. But they had forgotten a crucial lesson. Markets can be manipulated in the short term, especially markets as small as silver. The entire global silver market was smaller than many individual tech companies. Small enough to move with concentrated capital, small enough to control with strategic positioning, the trap had worked perfectly. Fear had been manufactured. Assets had been extracted. And now the true price discovery was beginning. But this was just the surface. The real question wasn't what had happened. It was why, and more importantly, what was coming next. 3 months before the crash, a veteran commodities trader in Chicago noticed something odd. He had been watching silver markets for 27 years, long enough to recognize when something didn't feel right. The trading patterns were changing, subtly at first, then unmistakably. Large block orders were appearing during off-peak hours. Asian session, European pre-market, times when liquidity was thin and price impact would be maximized. But these weren't normal trades. They were designed to move the market in a specific direction, downward. The trader began documenting every unusual pattern. He created spreadsheets, tracking order flow, timestamps, exchange locations, contract expirations. What emerged was a blueprint, a systematic approach to price suppression that most market participants completely missed. The mechanism was elegant in its simplicity. Paper silver trades on futures exchanges where physical delivery is rare. Less than 2% of contracts ever result in actual metal changing hands. The rest are settled in cash. This creates an unusual dynamic. Traders can sell silver they don't own, in quantities that don't exist, and face minimal consequences as long as they close positions before delivery dates. The leverage in these markets was staggering. Some estimates suggested that for every ounce of physical silver in existence, there were over 100 ounces worth of paper claims trading. 100 to 1. Imagine a system where 100 people hold tickets to the same airplane seat. It works fine until everyone shows up to board. Then the illusion collapses. The Chicago trader wasn't alone in his observations. In Zurich, a precious metals refiner was experiencing something strange. Orders for physical silver bars had increased 40%. But these weren't coming from typical buyers. They were coming from family offices, sovereign wealth funds, the kind of buyers who move slowly and think in decades, not quarters. The refiner checked with colleagues across Europe and Asia. They reported the same trend. Quiet accumulation, no urgency, no panic, just steady, methodical purchasing. While the futures markets showed silver crashing, the physical market showed something entirely different. Premiums were rising. A 1-ounce silver coin that should trade near spot price was selling for $3 to $4 above market. Delivery times were extending. What used to take 1 week now took 3, sometimes 4. The disconnect was becoming impossible to ignore. Meanwhile, algorithmic trading systems were amplifying every downward move. High-frequency trading firms had programmed their systems to follow momentum. When silver dropped, algorithms triggered more selling, creating cascading price declines that looked catastrophic on charts. Retail investors watching their screens saw only red. Panic set in. Stop-loss orders triggered automatically. Margin calls forced liquidations. The selling accelerated. But here's what those retail investors didn't see. For every seller, there was a buyer. And those buyers weren't algorithms. They were institutions with deep pockets and longer time horizons. A pension fund manager in Singapore executed his largest silver purchase in 15 years during the crash. His board questioned the timing. Why buy a falling asset? His response was simple. We're not buying the price, we're buying the metal. He understood that paper markets could deviate from physical reality, but only temporarily. Eventually, the two had to converge. And when they did, he wanted to own the physical asset, not the paper promise. The timing of the crash itself revealed much. It happened during a period of maximum economic uncertainty. Debt ceiling debates were intensifying. Regional banking stress was resurfacing. Currency markets were showing unusual volatility. Exactly the conditions when investors traditionally flee to precious metals. Yet silver was falling. Gold was falling. The narrative made no sense unless someone wanted to acquire these assets at suppressed prices before the inevitable policy response. A monetary historian in London studied similar episodes across centuries, from the Roman denarius debasement to modern currency crises. The pattern repeated. Authorities always chose inflation over default, currency debasement over fiscal discipline. And during the transition period, there was always a window, a brief moment when hard assets could be acquired cheaply, before the broader market understood what was happening. That window was closing. The 335 jump was the signal. The trap had sprung. Those who understood the mechanism had positioned themselves. Those who followed headlines and price charts had been shaken out. Wealth had transferred, silently, efficiently, exactly as designed, but the story wasn't over. The jump exposed the trap. Now the question became, what happens when more people understand the game being played? When physical demand overwhelms paper supply? When the 100 to 1 leverage ratio faces real delivery requests? The answers to these questions would determine not just the price of silver, but the credibility of the entire paper precious metals market. And for those paying attention, the implications extended far beyond one commodity. A successful textile manufacturer in Mumbai received an unusual phone call in early December. His financial advisor wanted to discuss something that seemed completely unrelated to his business: silver. The manufacturer was confused. He dealt in fabrics and garments. What did precious metals have to do with his operations? The advisor's response changed his perspective entirely. Your business isn't under threat. Your savings are. For 3 hours, they discussed something the manufacturer had never considered: currency risk. Not the exchange rate fluctuations he managed daily in international trade, but something deeper: the systematic erosion of purchasing power. The advisor showed him a simple calculation. 10 years ago, the manufacturer could buy a specific grade of cotton with 100,000 rupees. Today, that same cotton cost 270,000. His revenue had grown, but his currency had weakened. Not just against the dollar, but against real goods, against commodities, against tangible assets. This wasn't unique to India. The same conversation was happening in boardrooms across continents. A family-owned manufacturing firm in Germany faced a dilemma. They had accumulated substantial cash reserves, 3 million euros sitting in corporate accounts, earning minimal interest, losing value daily to inflation that official statistics vastly understated. The company's third-generation owner had learned business from his grandfather, a man who had lived through the Weimar hyperinflation, who had watched life savings become worthless. The grandfather had taught him a principle: never hold all your wealth in paper promises. But what was the alternative? Real estate was overvalued. Stocks were trading at historic highs. Bonds offered negative real returns after inflation. The traditional diversification playbook wasn't working. That's when a different approach emerged, one that wasn't taught in business schools or discussed at Chamber of Commerce meetings. The approach involved recognizing a fundamental truth. There were two types of assets in the world: those that were someone else's liability, and those that weren't. A dollar bill was the liability of the central bank that issued it. A corporate bond was the liability of the company that issued it. A stock represented a claim on future earnings, another form of promise. But silver? Silver was no one's liability. It existed independent of any institution's solvency, a property that became increasingly valuable as institutional credibility declined. A construction company owner in São Paulo understood this instinctively. Brazil's history of currency instability had taught him lessons. He remembered when the Cruzeiro became the Cruzado, then the Cruzado Novo, then the Cruzeiro again, finally the real. 4 currency changes in 8 years. Each time those holding paper wealth lost. Those holding tangible assets survived. He had started converting 20% of his company's cash reserves into physical assets. Not all silver. A mixture. Some gold, some silver, some productive land. His accountant protested. These assets don't generate cash flow. His response was simple. Neither does a fire extinguisher, until you need it. This wasn't speculation. It was insurance against scenarios that seemed impossible until they weren't. Across the Atlantic, a technology entrepreneur in Austin faced similar questions. His startup had been acquired, $42 million in proceeds. After taxes, $26 million remained. His wealth manager presented traditional options: diversified equity portfolio, municipal bonds, real estate investment trusts, all reasonable suggestions, all paper-based. The entrepreneur had built his fortune by recognizing patterns others missed. He applied the same analytical framework to his wealth preservation. The global debt-to-GDP ratio had reached levels never seen in peacetime. Central banks were trapped. Raise interest rates and governments couldn't service debt. Keep rates low and inflation persisted. There was no clean exit. Only choices between bad options. And when institutions face impossible choices, they choose the path of least immediate resistance, which meant continued currency debasement. He allocated 15% of his liquid wealth to precious metals, $3.9 million, split between gold and silver. His peers thought he was paranoid. That's excessive. You're betting against the system. His response surprised them. I'm not betting against the system. I'm acknowledging how the system actually works. He wasn't predicting collapse. He was recognizing incentive structures. Politicians who face deficits have two choices: cut spending or inflate the debt away. One is politically suicidal. The other is invisible to most voters. The choice was obvious. A pharmaceutical distributor in Singapore took a different approach. She didn't buy physical metals. Instead, she restructured her business operations, negotiating contracts with price escalation clauses, reducing payment terms to minimize currency exposure, converting excess cash to productive assets rather than letting it accumulate. She viewed her entire business through the lens of currency instability. Every decision considered the question, what happens to this if the currency weakens 20%? This wasn't pessimism. It was pragmatism. The trap that had played out in silver markets was a microcosm, a warning of larger dynamics at work. When paper claims exceed underlying assets, when leverage builds to unsustainable levels, when the gap between perception and reality widens, eventually reality reasserts itself, sometimes gradually, sometimes suddenly. The business owners and entrepreneurs who understood this weren't abandoning the system, they were simply refusing to be completely dependent on it. They were building redundancy, creating options, ensuring that their wealth preservation strategy didn't rely solely on the continued stability of institutions with questionable incentives. The fake crash in silver had revealed something important, not just about one commodity market, but about the fragility of paper-based wealth systems. And for those willing to see it, the implications demanded action, not panic, not abandoning productive business ventures, but thoughtful diversification into assets that existed outside the leverage chains, outside the counterparty risk networks, outside the systems vulnerable to policy errors. The question wasn't whether to own silver specifically. The question was whether to own anything real at all. In a world increasingly dominated by digital claims and paper promises, that question had become critical, and the answer was becoming obvious. A retired investment banker in London sat in his home office reviewing market data. It was late evening. His career had spanned 4 decades. He had seen market crashes, recoveries, bubbles, and corrections. But what he was looking at now felt different. The silver price chart showed the recent jump, but that wasn't what concerned him. It was what came next that kept him awake. He had learned something during his years on trading floors. The first move is rarely the last. When a trap is exposed, when enough people understand the game, the real volatility begins. Because now 2 forces collide. Those trying to maintain control of the narrative, and those rushing to position themselves before it's too late. The result is rarely orderly. In Tokyo, a precious metals dealer was experiencing unprecedented demand. His phone hadn't stopped ringing for 3 days. Clients who had never expressed interest in silver were suddenly asking questions. How much can I buy? How quickly can you deliver? What about storage? The dealer recognized the pattern. This was the early stage of awareness, when the mainstream hadn't caught on yet, but the informed minority was moving. He had limited inventory. His suppliers were quoting longer lead times, 4 weeks, 6 weeks. Some were simply saying unavailable, not because silver didn't exist, but because the supply chains were already strained. The gap between paper price and physical availability was widening. A hedge fund manager in New York noticed the same dynamic. He specialized in commodity arbitrage. His models tracked the spread between futures prices and physical premiums. The spread was approaching historical extremes. In theory, arbitrage opportunities like this shouldn't persist. Someone should step in, buy physical, sell futures, collect the difference. But the spread kept widening, which meant something was preventing normal market mechanisms from functioning. Either physical supply was genuinely constrained, or large players were willing to maintain loss-making positions to keep paper prices suppressed. Neither scenario was sustainable long-term. He positioned his fund accordingly: long physical exposure, minimal futures contracts. He wanted to own the asset, not the promise. A financial advisor in Toronto was updating his client presentations. He had been recommending a 5% allocation to precious metals for years. Most clients had ignored the advice. Now they were calling back. Should we buy now? Is it too late? What about the price? His answer was consistent. The question isn't about price, it's about position. He explained it using a simple framework. Imagine 2 investors. One bought silver at $28 per ounce. Another waited and bought at $32. 5 years later, silver trades at $70. Does the $4 difference in entry price matter? Not really. Both multiplied their wealth substantially. The mistake wasn't buying at the wrong price. The mistake was not buying at all, waiting for the perfect entry, which never comes. Because by the time everything seems obvious, the opportunity has passed. A mining executive in Perth, Australia had a different perspective. He ran operations for a mid-sized silver producer. His company's costs were around $18 per ounce. Current prices were around $31. Healthy margins, but he wasn't celebrating. He was concerned because he knew something the market didn't fully appreciate. New silver mine development had collapsed. The projects approved 10 years ago were coming online now, but almost nothing new was being permitted. Environmental regulations, community opposition, capital constraints. The pipeline of future supply was empty. Meanwhile, industrial demand continued growing. Solar panels, electric vehicles, medical devices, 5G infrastructure, all required silver. All were expanding. The math was straightforward. Declining supply plus growing demand equals higher prices. Eventually, the timing was uncertain, but the direction wasn't. A pension fund manager in Oslo was restructuring his portfolio. His fund managed retirement savings for 60,000 workers. His responsibility was generational. And these weren't short-term trades. These were assets that needed to preserve purchasing power for decades. He looked at historical data. Over the past century, every major currency had lost significant value. The dollar, the pound, the mark, the franc. All had weakened against tangible assets, not in straight lines. But the trend was unmistakable. He wasn't making a bet. He was acknowledging reality and positioning accordingly. 5% of the fund now held physical precious metals, stored in allocated accounts, not paper certificates, not mining stocks, the actual metal. His board questioned the allocation. Why hold non-yielding assets? His response was educational. Everything has a yield, including insurance. The yield is the protection it provides, the peace of mind during chaos, the optionality when others have none. Back in Mumbai, the textile manufacturer had made his decision. He converted 8% of his corporate reserves into silver, not all at once, gradually, over 6 months. He wasn't timing the market. He was building a position. His competitors thought it was strange. Why would a textile company own silver? He didn't try to explain, because those who understood didn't need explanation, and those who didn't wouldn't believe it anyway. The pattern was global. Individuals and institutions quietly repositioning, not abandoning their businesses, not predicting collapse, simply recognizing that the game had changed, that the old rules of portfolio management were written for a different era, an era of stable currencies and credible institutions. That era was ending, not dramatically, but definitively. The fake crash had been the warning shot. The $3 jump was the confirmation. What came next would depend on how many people understood the message. If awareness remained limited, the transition would be gradual, manageable. But if understanding spread rapidly, if the rush to physical assets accelerated, the paper markets could face a reckoning, a moment when promises couldn't be kept, when delivery requests exceeded available supply, when the 100-to-1 leverage ratio collapsed. That moment would separate those who prepared from those who waited, those who owned assets from those who owned claims, those who understood from those who believed. The opportunity was still open, but the window was narrowing, not because silver would become unavailable, but because the price of insurance rises as the risk becomes obvious. The retired banker in London finished reviewing his data. He closed his laptop, walked to his safe, and looked at the silver coins stored there. They represented less than 10% of his wealth, but they provided something no stock or bond could. The certainty that regardless of what happened to institutions, regardless of policy decisions or political chaos, he owned something real, something that had held value for 5,000 years, something that would still hold value long after today's paper promises were forgotten. He smiled. Not because he predicted disaster, but because he was prepared for possibility. And in an uncertain world, preparation was the ultimate asset. The trap had been exposed. The question now was simple. Who would learn from it, and who would ignore it? Until the next trap closed,